It takes us to our talk of the tape. Just how far can this rally go as the summer heads to a close and a potentially tricky fall looms? Let's ask our headliner today. Tony Pasquariello is global head of hedge fund coverage at Goldman Sachs. He's back with us at Post 9. It's good to see you.
Thanks, Scott.
So I'm always quoting from your notes, but it's good to see you in person. So 2 weeks ago Monday, we have this panic attack. Market freaks out. We've had this incredible comeback. Are we good? Are you comfortable with where we are now?
I think the bullish narrative has three pieces to it. I think the first is Q2 earnings growth. Earnings growth in general continues to print better than expected, better than feared. I think the second piece is the economy, in our view, is going to remain durable. So we forecast second half GDP growth of 2.5%. And then lastly, the Fed is on the precipice of delivering what we think is basically 200 basis points of rate cuts over the next 18 months. And so that is, I think, a very solid foundation for the bulls. Those are the big dynamics in the game. Those are favorable.
So that was just what, a rumble of fear that was overdone on many accounts, whether it was, positioning because of the unwind of the carry trade, plus this panic attack over the fact that, we had that jobs report the prior Friday, and we said, oh, my gosh, what if we're closer to a recession than we actually think?
You've got it. I think the sequence was one part a data trade, and the second piece was the positioning trade. I think the data trade was we had that run of disappointing U.S. activity data punctuated with 114,000 print on non-farm payrolls that flipped the switch, presumably, on the SOM rule. Then you had the BOJ kind of, in that context, make a move that ultimately the market rejected. That set off the positioning trade, which I think part of it was just this forced deleveraging from all corners of the market that, yes, hit the fever pitch that Monday morning with Nikkei down 12% and the VIX ultimately printing 65. I think, Scott, that was a moment in time. I think it was a lightning strike, essentially a global margin call, which, like I said, is giving way to a more solid fundamental story.
Is that pretty much what you're hearing from the hedge fund clients that you cover so closely, the best of the best, the biggest investors in the world?
I think so. I mean, look, I think folks are still holding their breath a little bit given the nature of the volatility shock. But what I had observed from my conversations on our franchise was I think the discretionary trading community, the folks we really call on and cater to, had done a nice job taking risk down in July and June and July, and then we're in position to play some offense in August. We saw very good numbers last week, so they caught some of that bounce back. The non-discretionary trading community, CTAs, vol control funds, they get a lot of attention. I think those are the heaviest hands in the down trade. That selling is done. The most interesting feature of our franchise activity was the buyback story, which is a big piece of our flow. We saw it very clearly, kind of ran 2 times normal, essentially reached record levels. Corporate America stepped into the breach. We think that's worth about $5-6 billion a day right now in the heart of the open window. Could be $1 trillion on the year. So we're back to corporates being the biggest sponsor of the market.
That's what was in the note that I think I saw yesterday from your trading desk. It was like momentum traders plus buybacks are enough stimulus to keep stocks climbing higher. We forgot that the blackout window was there because of earnings for buybacks. And now you're going to start hearing more and more, maybe even more so because of the upset that we had initially in stocks.
I think that's right. It was in a way, it was a very conveniently timed sell-off, if you will. Not that it wasn't ugly, of course it was, but you were in positions for corporates to act with force, which is clearly what they did. The other thing I should have mentioned is retail, who of course are the biggest holder of the asset class. They basically held their nerve. They held the line. They continued to buy. And again, point to point, that has been the right judgment.